Welcome back to the show, everyone. Today we have a very special guest, and his name is David Fawcett. David is the CEO, founder, and chief investment officer at Epic Capital. David, welcome to the show.
Hey, thanks, Robin. It's a pleasure to be here.
So you started Epic all the way back. I think you were one of the first hedge funds in Canada in the year 2000.
Yep. Yeah, that's right. Started December 2000, kind of just in the midst of the dot-com bubble that was starting to melt down. So that's when I started, and just a little over $1 million, and it was $150,000 that I had, and that was all I had, and some oil and gas CEO money. Just because I prior in the 90s had been involved in research on the oil and gas side of things. So yeah, that's when we started. So lots of things to experience in the last quarter century.
Oh, absolutely. And what were all the opportunities that you were seeing then? I know the dot-com bubble was busting. It wasn't really the start of the resource boom yet.
Mm-hmm.
I think it just got it going. But what was year one for you? Curious.
Yeah, it was interesting because when we just got going, sort of what you started to think was originally when we were setting it up is like, oh, how are we going to get involved with tech and how will we understand that? And then that was sort of rolling over. So definitely there was a concern that was going to continue for a bit. So interestingly enough, and one of the benefits of a hedge fund is we actually, for a couple of years, played a decent amount of risk arb. So at that time you could generate, you were levering a bit, but somewhere between 20 to 30% annualized returns. And there was sort of a lot of small M&A going on, so you could sort of spend time phoning management, try to get comfortable that the deal would close. Different from fundamental investing for sure, because it was more about, is the deal going to close was the main thing, not the fundamentals, not the competitive moat, which you would typically do from bottom up. But the nice part was it was a strategy, let's call it an arrow in the quiver that we could default to when things were a little bit turbulent, generate some positive returns in a difficult market, and then, as you just mentioned, sort of that essentially started to roll in and flatten out into a bit of a resource market, which was a little bit more of my background where I was coming from on the sell side.
Yep. And then you invested through probably the greatest of all times, recession and drawdown in the market, right? The great financial crisis in 2008. What was that like? What was the environment? What was going on?
It was difficult because we go back and then there's been movies made of it, and people now sort of understand how the subprime worked. But for those who didn't have that insight, which was most of us, The Great Short, and everybody kind of images them themselves as doing The Great Short with all that information. But at the time it was difficult because the market was under pressure and you weren't quite sure why, which is an unsettling feeling. And then sort of heading into the fall of '08 where sort of Lehman started to collapse and there was a lot of challenges and how things were going to get financed. It was difficult because for bottom-up guys looking at an individual stock saying, hey, this is a great management team and we really like the opportunity, and then the whole market and everything is just sort of selling around it, is a challenge. So it's an interesting lesson, and it leaves you with a little bit of PTSD for the rest of the time while you're invest in the market. Kind of if the market's a little bit unsettling, you're like, is there something going on I don't know about? Because I remember that one time and that really sucked. But with that said, it also was a great experience where it was a difficult time, and I think we were maybe down around with the markets, so it wasn't necessarily disproportionate. We'd always outperform the market. But it did leave a great opportunity, and one of our better years coming out of '08 was 2009 and 2010. So I think it also, despite not being that fun, did imprint upon us the opportunity that can be presented once sort of everything settles out.
Mm-hmm. And you've enjoyed since inception 16% annualized returns. You've been at it for a while, and now you're looking around, and I think you've been quoted as saying it feels like we were buying real estate in Miami in 2008. Are the opportunities that good right now?
I think that was a quote probably more for 2022, 23, but
Okay.
we really haven't come that far from that. So in a good way, right? So but those again, it just, going through, and it's interesting to sort of highlight that period of time, but it had similar vibes, and I think going into another difficult market, particularly, in the small to mid cap tech, because I think the broader market in the U.S. wasn't sort of quite as dire as the Canadian small to mid cap market was, but it did feel reminiscent of that type of opportunity where you sort of just keep doing your numbers and going, wow, I'm really surprised this is 4 times EV/EBITDA and there's nothing wrong with the company. This is a great opportunity. And although you sort of put up a bit of a negative performance for that year, you just felt great that you were actually planting the seeds for the opportunity for a recovery. And so although we've had a bit of a move, it still feels like more of a second, third inning move than it does like it was a trade and that's over. So and that really allowed us to have some strong performance last year. We were up 61% net to our investors. So again, it was the opportunity that 2022 and 2023 presented us to be able to have that type of performance coming out of that, where the market started to recognize some of these names a bit. And like I said, we believe it's just getting going, and the movements and the valuations are actually still quite attractive relative to the U.S., relative to historic. So it's still quite an exciting time, we think, to deploy capital into this sector, and just getting going, in our opinion.
Yeah, and although, compared to 2000, there's just continually so much capital pouring into these passive ETFs. Does that trend ever stop? Is this here to stay? What does that mean for active managers like yourself?
Yeah, it's a good question, and it's certainly quite powerful. And I think it's something that you need to be aware of. I think due to the relatively not great liquidity in the Canadian small caps, it's a little harder to have ETFs down there. So I think in a lot of ways, I felt, and there was a good global article on this maybe about a year ago, but essentially the Canadian marketplace, in my opinion, is a lot more inefficient than it used to be, and ETFs would be one of the reasons. Let's say bank retail guys not really being incented to push their product into their clients. Less sell-side firms doing this. Sell-side firms, because of liquidity, moving up CAC from 500 in their small cap maybe to $1 billion, funds closing, funds combining. And so all those reasons actually make it, in my opinion, more inefficient. And the ETFs, can help you if you can sort of see maybe potentially as something becomes more mid-cap, if they start getting captured in by the ETFs, that's helpful. But I think the big takeaway for us is it probably continues. It is a big force, but we're a little bit below them in the small to mid caps, and I think a lot of those reasons that I outlined, and the ETFs as well, has made it actually more inefficient. And I don't like using the word easier, but it just they seem the ideas, although they'll still take more time, they need a catalyst, they need reasons to go up. But the value and the opportunity is, if I was going to use the word, maybe more obvious than it used to be, and there's less people chasing into those names, as I would have found maybe back in the early part of the 2000s, where capital would be chasing the same name that you were interested in. You had to get there quick, so to speak, or first, and you just don't seem to have that as much. Some, but not as much as you used to. So I think it's a really, really big opportunity. You have to be more focused and have sort of almost different type of catalysts. And it certainly won't be, like I said, sort of capital following you necessarily. But they're still there, and you just have to change it a bit.
Yeah. You've said that value and growth is not mutually exclusive. So can you explain that so we can get a better idea of your own investment strategy for the fund?
Yeah, I think we would look at things generally in 2 buckets. Mm-hmm. I would say invest. I wouldn't necessarily value and growth, but kind of, I guess. But I would say investing and trade. So when investing to us looks more like growth. So we're just trying to find, something that looks more like call it traditional Warren Buffett-ish type business, where you think it's going to consistently add value. It's going to add value at something greater than an average growth rate. So let's say at least 15, maybe 20% annualized. You feel it has a competitive advantage in the marketplace. It has a nice defensive moat. You like the management team. So that's really what you look for, and not surprising they're not, you can certainly find them. What you were trying to get them is at a reasonable price, or, if possible, very attractive price is ideal. And then that really stacks your asymmetric risk reward opportunity, where if you can find a really good company at an attractive price, you feel like you have a really good cost base. You feel like over the next 2 to 3 years, the company could potentially double, triple, at least be up 50%. Whereas you don't think you have a lot in the way of fundamental downside. Let's call it left risk in any investment aside. And it also gives you, that we're pretty keen on entry point and getting a really strong cost base, because then that allows you to ride the volatility over time that is inevitably going to happen if a stock corrects. It's a lot easier to watch your profits get a little bit less than it is to go into an actual loss position. So I think even emotionally, it's a little more comfortable. And then the other bucket would be what we call trade, which would feel a lot more like a traditional value with a catalyst, right? So some sort of opportunity where we're going in and saying, hey, I think this company doesn't have a lot of downside. There's a particular reason why we think it's going to get re-rated, but we're really not in it for anything other than that specific catalyst. We're not interested in holding it for the next 10 years. I'll give you just a quick example for fun. MDF Commerce, which was a SaaS business in the US, is sort of essentially for governments to manage budgets. They really overpaid for an acquisition. In 22, got beat up with a lot of the small cap tech companies. We took a look at it. We spoke to we thought we were intrigued when the key shareholders brought in some new board members. We spent some time with those shareholders, with the board members, and got a pretty good idea. Their plan was they wanted to make some improvements in the company, then sell it. And we looked into it. It was trading at a pretty attractive valuation, like 2 times sales. So for a SaaS business, they typically trade 4 to 8 times, depending if you're quality. So 2 times was really low. They had a strategy of improving the company a bit. And when I mean that, they were just wanting to take some costs out, sell some real estate. The balance sheet was fine. But essentially, in our opinion, you had this business that was generally getting better, but not at a great rate, but getting better, not getting worse. Had SaaS business, which is sticky in long-term contracts. But we believe their intent was not to turn this back into a growth company, that was actually to go out and sell it. So that's a good value with a catalyst type opportunity, and that did happen, and they transacted, March of last year.
Yep. You're tracking the TSX venture volumes, and you've haven't seen them that low in 2023. Where do you see volumes now, and how do you see them trending up or staying flat?
Capital will certainly be attracted to performance. So I think if, I don't know if it'll be a specific trend, gold gets hot, energy gets hot, you would see some capital. But I think it's really going to always be driven mostly by performance. So ideally, although we talked about the inefficiencies, I think they're still there, and maybe they won't go back to, the higher volumes we've seen in the past, but they should trend up as performance, and the sector tends to work. Capital will find it, whether it comes from the US, whether a new fund comes in, whether the funds that are investing in it now get more capital. But we're constructive overall in the sector for sure, and those volumes should tick up through the performance, bringing capital into the space.
Yeah, and volume, I believe, is been highly correlated to these mega trends, right? Companies on the TSX Venture Exchange, like mining, right? Then cannabis, and a lot of people were burned by cannabis. A lot of retail investors have just gone away and haven't come back yet, right?
Yep. Those are 2 good points. Yep. And again, this sort of, in our world, we think just capital, you'd just like it to ideally come back and not have to be bubbles that that bring it back to the marketplace. But
Yeah.
sometimes the bubbles seem to be stronger magnets of capital than just general good performance, unfortunately.
Yeah. And talking about these value opportunities where you're looking for a catalyst, I believe you mentioned you also look for companies emerging from bankruptcy. How do you play those opportunities?
Um, yeah, I mean, I think there. I think any sort of turnaround emerging from bankruptcy, they're just interesting starting points to look, right? And it's not to say that that's for sure going to work, but what you do like is just you like where the market doesn't typically like a company, and if they're going to go into bankruptcy, then they probably don't like it. So companies emerging from that already don't. The market's really not interested in looking at it. People don't want to see the company. They're tired of it. They were burned by it. And so that's kind of a nice starting point, right? And so, ideally, we would prefer a new management team coming into those situations as opposed to the old one, almost for obvious reasons, I suppose. But, if you can have somebody coming in with a new set of eyes and a new strategy and a better pedigree, then that's even better. But, spin-outs and bankruptcies and turnarounds, they're all kind of under the same bucket of almost more interesting entry points that I think you always at least have to look at, and we don't always invest, but it's just such a great starting point where the market's unhappy with the story. Analysts have thrown in the towel. Nobody wants to look at it again. Maybe something really interesting is evolving where nobody's paying attention, and those are your opportunities for, particularly better returns coming out of situations like that.
You run a very concentrated portfolio, David. I believe it's only around 8 to 10 stocks. Have you always run a concentrated portfolio? Has that always been the philosophy, or has that evolved over time?
It's always been concentrated for sure. We've had a few different strategies throughout our time. So the one fund we're talking about was inception was 2006. So it's always been a concentrated end of the spectrum. It was always a make your best ideas matter. And it was always, I always felt like the things we were looking for in a particular investment and to really get that, not only is the entry point good, not only is it a quality company, but, do we feel we have a view of the story different from the marketplace? Like if it's cheap, is it cheap for a reason that we think will change and can re-rate? And when you're looking for those sort of specific metrics, typically we don't end up finding 20 of them, is what I'm saying. So you're going to end up like I would have a more diversified portfolio if we could find those, names, and if we could find 15 instead of finding 6 to 8 to 10. But the history has suggested to us that's about the number that we can typically come up with. And it's also, there's a nice dynamic when you're concentrated too, that there's really a competition for capital. So once you find something that you really love, and hopefully you have a handful of those names you really love, then it's hard to knock them out because something comes in. Because it's so easy I find in this business, in an absolute way, go, hey, that's kind of a cool story. I like a lot about it. It's interesting. I mean, typically, I think a lot of us on the buy side like buying, a new name. It's exciting. But you really have to be, once you put it into the relative world, it becomes a different conversation. We're saying, am I really that company that I just spent 2-3 years on, getting to know management, getting to know the sector, feeling like we have an edge and an understanding versus the street? Are we going to really sell that down to buy this new company that, sure, it's kind of the shiny new toy, but so I think that's a nice dynamic that does come out of a concentrated portfolio is a real tension, healthy tension when it comes to investing in new names.
Yep. Let's talk about some of these companies in the portfolio. So first off, MDA. I believe you recently visited their satellite, I think. So tell us more about that.
Yeah, I would actually say that's probably our, well, not probably, it is our biggest position. Hang on a sec, Robin. Sorry.
Yeah.
You got me, Robin? Sorry, I just
Yep.
somebody tried to phone. Yeah, so MDA, we looked at that probably around $10. It's probably around $24 today. But this really encapsulates, and I think right here, right now is a great price. It had a bit of a correction because it was around $30 at the end of last year. But I think this really encapsulates something that we like. And so when we met the company, um, they were talking about growing their top line 30% for the next 5 years. And that's organically. That's some pretty extreme growth for a company with around $1 billion in revenue. And we thought that was quite interesting. If you break down the businesses, they have like this geo satellite, which essentially kind of takes Google Maps in real time. That business, they're just putting in a second gen satellite. That's about 20% of the revenue. That's a SaaS business, so just meaning good, steady business, fine. The two other businesses, though, that are the growth engines are their space robotics, so doing things like the Canadian Arm, but also other sort of robotics that they put on with all these, ambitions to go to Mars, to go to the moon, to have a new international space center. They'll be the ones doing arms and robotics. So that business they expect to double every 2 years going forward. And then the satellite business, which is the LEO satellites, which people may be familiar more with the Starlink as a LEO satellite. And that business also is expected to double every year for the next couple of years. And so we got really excited and go, wow, this is like amazing growth. And even today, it probably trades at 10 to 11 times EV/EBITDA, maybe as low as 7 next year. And, that type of growth, I really don't need comps to know that growth doesn't match up to their growth rate versus the valuation. There's nothing wrong with the balance sheet. The company's profitable, probably 20% EBITDA margins. So you sort of ask yourself, like, why is this case? And I think part of it is because it's just not a lot of space experts out there. So you actually have to start doing some sector digging. A lot of people know SpaceX, but it still is private, and so it gets profiled with Elon, but that doesn't mean there's not a lot of analysts covering it. Even in the U.S., these LEO divisions that are building out are divisions within Lockheed, Northrop, Airbus, Thales, so they're not even separate divisions. And again, SpaceX makes their own satellites and launches their own satellites. But what's a really interesting trend that I really think the market is deeply missing is Apple essentially is going to have a bit of a space war, basically a bit of a satellite war with Elon, and they want to control, direct-to-device to their own phones. So Apple just awarded MDA their second contract a few weeks ago for $1.1 billion, 50 satellites. But this is their second contract. So first of all, we have a validation of, we believe, the best at building digital satellites out there right now, or at least that can outsource and build somebody else's satellites. In fact, Thales and Airbus just hired Goldman Sachs to try to figure out their divisions. So they're well behind. I think obviously the data points would suggest that. Here's MDA as a global leader. They're currently, the facility that you mentioned that we visited was in Montreal, and it's going to, at the end of this year, be able to produce 400 satellites per year. So if we do the math on that, they sell it at $10 to $20 million per satellite. That's $4 to $8 billion in revenue potential per year. Now, I wouldn't say they'll get there fully, but the potential is there. And if you look at last year, they did $1 billion in top line revenue, to give you an idea of the optionality that's embedded here. We literally have them being identified, or we think data points to suggest they're a global leader in building these. There's articles out there saying that the LEO satellites will continue to provide, very high quality connectivity outside of the core areas. Some were going as far as saying, and maybe this is too far right now, but maybe they'll challenge the telecoms at some point. So you literally have Apple, we believe, fighting with lots of data points against Starlink for sky supremacy. MDA is the builder of choice, and this is Apple. Apple has registered for 3,000 satellites. They just gave them a 50 satellite order. So we think the upside is tremendous. We think Canada has not had many global leading companies in the past. I mean, what are we talking? Nortel for a cup of coffee, BlackBerry for a cup of coffee,
Shopify now, right?
Shopify now. So, but it's relatively rare, right? So
Hmm.
I just think the market, is not fully appreciating this opportunity. The growth for the next 3 years is already booked. Like, what's my risk? I shouldn't say that. I mean, I guess tariffs sort of loom over a little bit, so that'll have to be managed by them. But the Apple contract was signed with all the tariffs well aware. Their last prior contract was 2 billion and a bit with Telesat. Telesat's a Canadian company. Also, they're building a product that there's really no switching. So, in all likelihood, they believe they can push back a lot of the tariff onto the customer. So in any event, I just think that's something, and that is by and large, given what I think is awfully modest valuation, given the opportunity, given the global leadership, all tangible, all backed up. And again, I can kind of explain it because doesn't have a U.S. listing. There's really nobody that actually covers space as a sector. It's always just kind of a special sit for everybody. So I can kind of understand why it's being there, but even some people have written, space could be, AI is the current bubble, and space could be the next bubble. Yep. And here we are with a global leader, and it almost feels like, it's not getting nearly the attention that we believe it should.
Is Telesat also a position in the portfolio? And if not, why?
It's one we haven't become vocal on, but I guess if you ask, I'll talk. Telesat's very interesting, and I think, if you want to become interested in Telesat, there's some quick back of the envelope numbers to do, and then you'll become interested. They claim with their light speed, with the new MDA satellites, that they can do, and I think if the number's right, $2.7 billion in EBITDA in 2023. And the company has about $1 billion market cap right now. And you should probably trade it about 20 times since it's about a 75% EBITDA margin. So you're literally talking 30, 40, 50 bagger if they execute on their strategy. So you can understand why it should be at least looked at. Mm-hmm. They're run by quality management from what we can understand. And the one thing that will keep people away for a while, which I understand, is the business is set up under two corps. And the Lightspeed, where there's about $1.6 billion in cash was in there, and the government debt to fund the Telesat satellite purchase was put in this, is ring fenced from the other business. So the other business has debt trading at 50 cents to the dollar. And that's due in 26 and 27, and that debt will need to be settled. So I think there's a bit of a murkiness when you consolidate the two in the financials to say, hey, why would I buy a company with debt trading at 50 cents to the dollar? Although if you sort of talk with management and you sort of see that they've actually ring-fenced it, and the Canadian government talks about it being ring-fenced, and I got the guy's name right, Mark Rajewski is the chairman, and he was the former CIO of Carl Icahn. So he's the one that's going to negotiate the debt. So this is a very familiar ground for him. Mm-hmm. And 75% of the company is owned by private equity. So it's a name we're tinkering around with. There's the debt would need to get settled for sure. And I guess there's some risk there if you ever thought it would go to court and drag out. Our understanding by talking with different groups is that wouldn't be the case, and it's likely to get settled this year. But that's a risk everybody needs to be aware of. Yep. But if it does come through, there is considerable upside. And again, you're back to like Cormark covers it, and nobody else is talking about it, primarily because of the debt, primarily because of 75% is owned by private equity.
Yeah, so underfollowed, which is the theme. The next position I believe that you still hold in the portfolio, Kraken Robotics, and I think the founder recently passed away, I believe, right? Of Kraken.
Carl, yeah. No, it's unfortunate.
Yeah.
No, that was sad to see, a good Canadian entrepreneur pass.
Exactly.
Yeah, that was the stock. Well, again, it'll kind of have a bit of an MDA flavor to it. You know, we posted. I think our post really encapsulated it back in sort of the summer of 23. We said the market doesn't believe their 40% organic growth. We do, and I think, you know, we looked at the company back then. The guys, you know, expected to grow 40% that year. And at that point, they had done 20 million in the first half, still needed to do 50 million in the second half. So this is one of those stories for us, is like, if this is true, this is really amazing. It was only trading at 7 times EV to EBITDA and 4 times forward, which would be a ridiculously low multiple for that type of growth. So we spent time with management, with Greg and Joe. They were really helpful to us, and really walked us through, quite frankly, contracted revenue that they had for the second half, which gave us a lot of confidence. And then the question was, well, can this continue, and why are they growing at this pace? And so what they do, they essentially have 2 technologies, and one's like a sonar, which reads the ocean bed imaging. It does it quicker and better with higher resolution than their competitors. And then also for underwater autonomous vehicles, they have a battery set that actually is about twice the length of all their competitors. And prior to that, it was really a business. I mean, these were used for mine hunting, and you kind of look at it and go, mine hunting, like this World War II, or I didn't know that was a thing. But this is one of those stories where they had a niche technology. They were very good at it, but the TAM around it started to explode because all of a sudden sort of the U.S. Military started to care about autonomous vehicles. So we first started, so we did, you know, this is one of those things you have to do, is like, why do we think this will keep going? So we started doing some work on the sector. We found a transcript from the U.S. Defense Secretary's speech, and it's very clear she was going on about how she was criticizing the U.S. military for not being nearly as forward in tech. They're like, Silicon Valley's right here. We're not using it. This is ridiculous. You know, cost plus. This is ridiculous. Like, why are we having, you know, soldiers die when we can use autonomous, when we have software, when we have AI? So there was a real push by the government, which obviously funds the U.S. spending, to move into this direction. So that was very encouraging. We started reading stuff on one of the major customers for Kraken was Anduril. So that was like a sexy U.S. startup that was funded by Andreessen, and you know, they were trying to disrupt the defense industry, sort of like Tesla disrupted the car industry with being very tech forward, very software forward, very autonomous, not cost plus, and really going in there and winning a lot of business. And that was one of the major customers for Kraken. So Joe and Greg were kind enough to set up a DD call with their head of underwater division, Bill Lebo. And that kind of was a really important call for us, because we chatted with him, and he's just like, yeah, we're doing this underwater vehicle, which is a dive. It's about the size of a car. You know, we want to move that to mass production, and we're going to use the Kraken battery. You know, we've done a search across the whole industry. We know what we're doing. This is the best battery. Then we also want to move to mass production eventually to our Ghost Shark, which is about the size of a bus. And if you're following the story, you'd see that Australia's ordered a few of these vehicles, and even just what the Australian what they were saying on the military side is, they're like, why would we wait 10 years for a nuclear sub, which is going to be cost plus, which is going to be late, and which is going to probably take more than 10 years, and we got troubles in our ocean now, where I can get an autonomous vehicle in 2 years at a fraction of the cost. This is kind of a no-brainer, and they just asked Anduril to do some of the work actually in Australia, but you know, Canada might want to do something like this actually. But right. Little poke. But it was really a matter of, you know, them saying that they were going to grow at 40%. The valuation was super cheap, and then us being able to prove that this TAM, this growth, this opportunity was actually, could we validate it? Could we gather data points to support the investment thesis? The more data points that we could, you know, gather, the more robust, the more confident we could be, and then you can move into taking into a core position at an entry cost that was really attractive. And actually, you know, you mentioned Carl, and it was 2023. The market was soft for small cap tech. Carl, for personal reasons, and probably understandable now, was out
Yeah.
sort of selling some stock and liquidating. And so, those are, the MDA and the Kraken is really, ideally, you'd want a portfolio of as many of those as possible, which would be, those high growth, competitive advantage, low entry point. Again, it's hard to get, but that's essentially what you're searching for, at least from an investment standpoint, as opposed to sort of a trade.
Has your thesis or conviction in Kraken Robotics changed at all with the changes happening in the U.S. with the Doge program and cost cutting overall?
We lightened up on it primarily because of share price performance. Okay. It's just, sort of moved a lot quickly. I think probably almost 7 times since our initial purchase over.
There's a lot of retail investor enthusiasm, right, around Kraken Robotics. A lot.
Listen, it's like they if they're not even close to fulfilling what, back to our DD call with Endurl. That upside is still there. Huntington Ingalls, they have a board member that was associated with that company. Peter, I forget Peter's last name. So there is a lot of growth in this sector. You could make the case that Endurl would buy them. They just recently, I think they're in the midst of a capital raise, significant capital raise right now. Excuse me. So I think that's on the table. But really, with that type of move, we had to move down our position.
Let's talk about Shawcor then. Shawcor was a sum of the parts thesis. Can you walk us through your thinking there?
Yeah, it was a situation that nobody been paying attention to the company for a while. New management came in with sort of a vision on the different divisions and what they believed they could do. And that was one that falls back more into our trade, because that was one that we thought that the market wasn't recognizing. It was way too cheap. They had a business that they wanted to sell. Nobody was really giving them any value for it. Nobody liked it because of the volatility in that particular business. They hired Goldman to sell it. And when you did the sum of the parts, you certainly got a higher valuation. So, we were in and around, just try to remember, probably around 6, and then it sort of started getting recognized by the market with some, and some positive quarters, and then sort of between probably 15 to 20-ish, we sort of exited because, again, it was really, we weren't sort of there for an investment, we were there for a trade.
Yep. That's great. How about vertical scope?
That's one, probably started buying, it was one of those ones we got sort of offered. I think like a fund was selling out back in 23, maybe around $4, if I remember correctly. And we took a starter kit, which we'll do, where we sort of got the pitch from the analyst, and it sort of seemed cheap and interesting, but we didn't know it that well. So maybe we took 1 or 2% position to sort of start off because it looked like it was a good entry point. Did some work, followed the company, spoke to Rob, the founder. He doesn't really talk to investors a lot, but we sort of chatted maybe about a month ago. And essentially, I guess you'd sort of think of it as a mini Reddit. So they have the communities where there is a big movement out there, and I think one of the reasons why Reddit is doing well is there's a real movement towards, authentic content. Right, so I'm sure if you've ever said, "Oh, what are the best hotels in Miami?" and like you have 4 pages of advertising, and it sort of gets a bit frustrating. So, I think as people gravitate more towards genuine content, not AI generated, these formats where people might be talking about mountain bikes, might be talking about watches, cars, but it's actually, if you actually care about the topic, it is actually a good place to go to be able to get what people actually think and get away from advertising and bots and whatnot. Yep. So there's value. So the advertising dollars are starting to get better there. The ARPU is starting to get better. So they've created a nice little business. We think they can actually grow around 20%. I'd include a little bit of M&A in there. There's a few things that should drive it, and also I don't know, I can't remember the exact where it's trading today, but maybe 7 times EV/EBITDA. It's had a bit of a move recently. Maybe it's slightly more than that. Still pretty strong free cash flow. So healthy financials and still lots of opportunity to sort of continue to grow. They're going to introduce a mobile app they're pretty excited about in the summer that should sort of help drive engagement. Engagement can lead to increased ARPU. Also, they haven't done M&A in a bit, sort of their balance sheet is in shape to be able to do some M&A. When they do that, when they find another form, because they just have all of their users, they can migrate users across to that. And more importantly, they can take these forms which they buy and really juice up the revenue because they have a better direct advertising, better programmatic advertising with Trade Desk, and so they can sort of juice their revenues once they buy something. So I think the M&A could be robust. I believe they're sort of working on some things. You never know if those all work out or they can get the right price, but they seem like pretty disciplined guys, so we're encouraged that they can add a lot of value through the M&A side of things. There's still the LLM sort of angle where there's we call it some free call optionality there. It was Google gave Reddit, I think it was $60 million per year for the next few years to train their large language models on. That opportunity still exists with Reddit.
There's just so much data.
Yeah,
across
Reddit's
all these websites.
Reddit's about an eighth Thesis size, so I don't know if that quite translates into the same sort of math, but it's possible. Another move they have to increase users is now with AI being sort of as good as it is, they can actually, they're looking to translate into different languages, right? So your Reddit board, your vertical scope board can flip into Spanish, and you can have people jumping in, and so with not a lot of effort, you could actually sort of increase into a few other different languages as it more seamlessly flips back and forth between the different languages. So I think like it's a nice little Canadian sort of cool little tech company that has some decent growth. Again, sort of probably most people not paying attention to, but it's a healthy.
Exactly. It's definitely one of those sleeper stocks. But I think if people have ever used red flag deals, I've been going to red flag deals for years now. I believe that's one of their assets, one of the websites that they do own. Here's one that people are sleeping on now. It used to be a market darling though for years. I think everyone was recommending it. The acquisition fell through. They're going to be acquired. The pandemic happened. That company's Cineplex. What do you see in Cineplex today?
Yeah. Well, yeah. It was a always a well-respected, well-run company prior to COVID. Decent EBITDA, good free cash flow, paid a divvy, balance sheet was decent. Yeah. And essentially a monopoly in Canada for all intents and purposes. And then they wanted to sell. They had a deal with Cineworld. The pandemic happened. Cineworld walked. They had a lot of debt. They ultimately filed for bankruptcy, so that deal fell apart. Then they were left with having to manage through COVID and with no attendance in the theaters, so that was certainly a challenge. So they did the best they could, lower leases, got some money from the government, added a little bit of debt, and fought their way through. And then there is a bit of a slippage from, call it pre-pandemic attendance. So the attendance is, they always say they're trying to, and the industry, and if you actually look at the Cinemarks and the Canopolis, they all sort of talk about trying to get back to 80% of attendance levels of pre-pandemic. They think that's a flat line, a fair level to get to. And so that's what Cineplex has been striving to do. In the meantime, to make up for that shortfall that they would have had on that 20% of the attendance, they were increasing ticket costs. They were increasing the cost of food per patron, and they also added some location-based entertainment sites. And so, putting that all together, they're pretty much there now. There was an air pocket in the first half of last year because of both a writer's strike and an actor's strike. So there was a bit of a lack of content.
There's a lack of releases, yeah.
Yep, that's right. But they're kind of back now. The financials are awfully close to pre-pandemic levels. And they're pretty much got there in the second half of last year. So if you look at it, the company is about $100 million in free cash flow. It's a little bit heavy on the debt, but it's nicely termed out to 29, 30. that money can just be used to, bring down your net debt. They are buying back a bit of stock. Wouldn't surprise us if they put in a dividend, but they're in a healthy position. So that's good. But we also think they want to sell. So you're back here to a value with a catalyst story. Here's a trade, right? So I think we started picking it away at 8. Maybe it's 10 something right now. But in conversations with management, they don't quite come out and say it, but we think they're saying, sort of essentially alluding to, getting that stock up to $15, trying to sell it for 20.
Who would be a buyer this time around?
I think you could look at private equity for sure, but if you even just look at the comments on Cinemark in the U.S., they're clearly like, we want to. They've literally said we want to buy through M&A. We want to grow through M&A. They're in a healthy spot. They're in healthy financials. And they've literally said, hey, I think some of the companies we want to buy just want to get their financial footing before they want to sell. And I'm like, oh, that's interesting. It sounds like something we know. And Canopolis out of Europe kind of said something similar and actually mentioned at one point talking to Cineplex. So it just seems like you have a company that is financially, it's free cash flow generating, and it wasn't in the past, which is great. So it's adding value that way. It is cheap. They're going to buy back stock. Kind of got to where they want to get to, and I think they want to sell, and I think there's buyers. So I don't know. It's nothing's for sure in this type of world, but it was the same investment thesis when we had MDF Commerce. We believed that it was cheap. We believed that they wanted to sell, and maybe from our first investment it took a year and a half, but they sold, and so I think that's the situation we're dealing here with Cineplex.
Well, I hope Cineplex can sell before the next pandemic. I don't know, David, if you saw the news on Friday that just passed, but there's rumblings of a new coronavirus that's been discovered at a lab in China.
Yeah. Well, let's just hope that's not true.
No, that was not true. Exactly. We don't want to live for that again. That was not a fun movie that we want to rewatch.
No.
So up until now, we haven't talked about any resource companies, but I've seen hints that you might own Athabasca Oil in the portfolio, or you did?
We own a bit of it. We're sort of, the challenge right now is stupid tariffs, right? Like, because we don't really, I would be deploying more capital into the patch, because I think that's a situation. Like, generally speaking, I think the energy patch, since about 2017 when they had their major correction, and I guess sort of culminating in negative oil was really their trough. But they've spent so much time getting their act together, so much time improving their companies. Like, they're just, I was an oil and gas analyst for Deutsche Bank, First Marathon associate back in the 90s, and they don't look like this. Like, they would spend, 1.5 times their cash flow. It would all come from equity issues and debt. ROE would be nothing you ever heard of. Buybacks, nothing you ever heard of. Dividends, not. So, I think they're just in such great shape. So, I mean, Athabasca is a good example of there's a company that has embedded about 20%. They're going to double their production by, got these numbers right, 2028. So 35-ish to close to 70-ish BOEs a day. Internally funded, no debt, and on top of that, they'll generate about $1.8 billion in free cash flow over that period of time. So that's, and so that translates into about a 20% CAGR in your cash flow per share, because they're also buying back a shit ton of stock. And you almost have an infinite reserve life. Like, I don't know what you want to use. Their reserve life is going to pass our lifetime. So, so they don't even need to find new stuff, and they still have some additional opportunities. So I think the patch is being missed. Unfortunately, we do have the cloud of tariffs over it that I think ideally, we're light in the sector, because I don't think the market cares enough that if the tariffs went away tomorrow, the stocks would all probably go up 5%. You just buy them then. And I think another sector that's kind of cool and overlooked is the drillers, right? So, because if you look at, if you look at the natural gas situation right now in North America, so I don't know, maybe think of the U.S. as about 100 BCF a day of production consumption ish. They already have in the next 3 to 4 years about 12 BCF a day of takeaway capacity coming from LNGs. Like that's booked, it's coming on. I'm sure with the Trump regime that'll increase over time, but this stuff's booked and it's coming now. You look in Canada, we're about 18 BCF a day of production ish. The Shell LNG is supposed to come on this year at 1.8 BCF a day of takeaway capacity. We have a bit of a little bit of an oversupply in Alberta, so the price has a discount. So hopefully that'll take away the discount. Most industry people believe that the LNGs that Shell will add another phase. Maybe they do, they don't, but that would be really positive if they did. So that's like a nice sort of layout for natural gas in North America. Then on top of that, you sort of say, well, how are these guys going to power the AI data center craze, right?
A lot of energy, a lot of it.
A lot of energy, and they don't want them to plug into anybody's grid because that's a nightmare, right? So you have to build a new source of energy. Facebook, Microsoft, and one of the other big dudes, probably Google, has said, they'd like to do nuclear power, but whether you're green or brownfield and nuclear, that's 10 to 15 years out, right? So you sit there and you look at the natural gas situation, you go, wow, I got embedded growth from LNGs, both in Canada and the US. I see it. It's coming. It's meaningful. The AI data center growth, the numbers are all kind of new, and it's hard to sort of for sure know what numbers are valid, but it's a lot. And it's really not even talked about much, but it's the clear, obvious source of energy that's going to power these data centers. And then you look at the drillers in Canada, and I got companies trading at 2 times EV/EBITDA.
And they're just left for dead,
and
right?
They're left, and they're good. They're really good at ROE. I've followed them for 30 years. Management, they're highly proven. Their balance sheets are in great shape. They pay dividends, and I have a massive call optionality in front of me. So we've accumulated some of the Canadian drillers. Again, I think unfortunately the sort of this tariff, and they don't really get directly affected by the tariffs, just because it wouldn't, they're not going cross border. Just their customers might. And some of the guys do have, that we're invested in, do have some assets in Canada and then also in the U.S. as well. But I think that 2 times is a broken company, right? Typically, but not like. I don't know, one of them I think is like 50%, 2 of them are 50% free cash flow per year at 2 times EV/EBITDA. And you're just like, oh,
my
okay.
goodness. Because you remember the heyday of oil and gas, like companies like Crescent Point Energy,
Sure.
what was it, the Canadian Oil Sands Trust? I'm sure you've got so many more names, right? Like they're trading at much higher multiples
Oh, yeah.
during the peak. Yeah.
Oh, not even that long ago. We had one of the guys showed us that we deal with guys over at ATB. They showed a chart who got us interested in, and I'll tell you one of the names was Total Energy, but it was like a 5-year chart or something, and they had him trading at 6.5 times EV/EBITDA, and they had the share price, and then the EV/EBITDA went down to 2, and the share price still went up. You're like, your multiple got cut by 2/3, and you're still did well enough to improve the share price. So, I think, like I say, like there's an opportunity, and it sounds a bit strange at first when you say, hey, you're going to be playing, AI. Yeah. But if you back it out, you're playing data centers, and if your data centers need to be fueled by something. But the way I like it is, okay, that's all fine, but there's a lot of things you could play if you want to play AI, but I bet you there's nothing you could buy at 2.5 times EV or 2 times EV/EBITDA that gives you exposure. So there you are, as an investment over the next few years, what's my risk reward? Some of them don't even have debt. So where are we going here? And I don't know, for some reason, just the industry, like nobody really seems to talk about it or care about it. I mean, a few guys do, but it's not a loud drum. And at the ESG, and everybody walked away from energy, and the pension funds walked away from energy, which is, unfortunate. But that certainly was a big, you can get yourself pretty comfortable to give yourself a lot of reasons why we are where we are. But if you look at the individual names and their ROEs and the dividends and the balance sheets and the proven management, I think you have an exceptional risk-reward investment, just exactly the type of thing we look for.
it started to make sense why maybe Trump is trying to take over Canada, right, and make it the
Yeah,
first state.
yeah,
Perhaps he's being lobbied by all these big tech companies that you
yeah,
named.
yeah,
There's a lot of
maybe.
energy needs, right?
Yeah, yeah, yeah. You could be right.
The next company here that I believe you still hold in the portfolio, Sylogist.
Yeah, that was kind of been a well, it's a turnaround story. Bill Woods got in, and the company was essentially milking the cash flow. I think they had one salesperson, paying themselves a lot of money. So he had his work cut out for himself, but he brought in a bunch of new people, new board members, which is great to see. Improved the management team. And then their idea was they spent a bunch of money on sales, and they might have spent a bunch of money in getting improving the tech stack and having a leading edge tech stack. And what makes it an interesting dynamic, so as they're selling SaaS software to sort of K to 12 and some nonprofit organizations, Blackbaud is the incumbent in the U.S., but probably think about $1 billion U.S. in revenues, and they haven't bothered increasing their tech stack. In a lot of ways, I guess I don't blame them, because I think these organizations and government organizations really aren't sort of encouraged to get more recent until it really gets old and crappy, and they just keep rolling. But so Blackbaud just sort of instituted be much more aggressive on contracts. So when they roll, their price increases are 10 to 15%. They're pushing them into 2 to 3 year contracts. The good news is Sylogist, with only about a 65 million in revs in Canadian, can go in there, and they don't have to win all of that market share, but for them to have a decent amount of growth, they can do that. So this year, they're growing their SaaS revenue nicely. They have some project management revenue that's probably going to decline, that's lower margin. So their top line growth is probably about flat. But once we get past that, you should start seeing some top line growth. In a SaaS business, a good healthy SaaS business should trade, maybe 6 to 8 times, and it's probably still at 3. So I think it's still getting a little bit missed by the marketplace, and we'll still have an opportunity as it transitions and improves the quality of its earnings this year, and then the growth we expect to sort of really pick up, and margin improvement to really pick up as we get into 26 and 27. 26, 27.
And maybe we're saving the best for last. Vitalhub. I'd love to know, how did you first discover Vitalhub? What's the story there?
Yeah. Oh boy, we had a relationship. Dan's prior company, but we knew Dan Matlow.
MedWorks, I think, right? But
that's right. That's
yeah.
right. So we had followed that company, and then a prior partner of mine, Scott Planis, did a little bit of M&A with a company that Vitalhub ended up purchasing back then. We also followed the Shens. And I'm going to forget what their prior company was, but they were buying those essentially old telecom stuff, but really using the cash flows. So I think that's an important part of the story, just to know how good the sort of the investors were behind it in doing M&A, right? Because M&A is, anybody can do it, but you can also do a pretty crap job. And if people don't have a track record of doing it, I mean, you have risks all over the place of overpaying, not properly doing your due diligence, there's a whole host of things that can go wrong during M&A, and I think people sort of gloss over that way more than they should. But the Shens have a great track record of doing it, so not surprisingly, they implemented an M&A strategy, and they do a great job, and that's really been a big part of the value creation. And Dan done a great job of moving that company forward and starting to justify a premium. And once you get that premium, it's not, nobody's saying it's going to quite be Constellation Software, but the whole idea of having that premium going into a marketplace and buying things accretively when your investors sort of are willing to give you that premium. If you do those deals well and actually have the cost of capital, It's almost self-fulfilling, really. So I think it's hard work to get there, but once you get there, then you do have a nice competitive advantage that they may be able to maintain for a while.
And then short selling. Do you ever take part in shorting any stocks in the portfolio?
Um, I mean, over the years we have. I just like that asymmetric risk reward is never great.
Yeah.
The best you can do is 100, and then worst you can do is infinity. So, and short squeezes and all that sort of stuff. So I don't know. Over time, we do it less. Right now, we have an index hedge in the Canadian market just because of the tariff stuff to sort of give us, I don't know, a little protection on the names. We have a little bit of the XEGs against our energy names. Same idea, same reason. Just if you had, tariff news come out, probably goes down, probably just cover, hopefully make a little bit of money. But right now, like in the mid to market, it's not really the right environment for, like, if you want a good short and give yourself a chance to stack the deck in your favor, you kind of want a hot, overvalued market, right? That's not where the small mid cap is at all. We're sort of in the early stages of a re-rating, hopefully, of the marketplace. There's some companies that have run well, but they just tend to be good companies. So, I mean, at worst, maybe you're going to they might get a correction, right? They might go down 10 to 25% because they were up so much, but that's not really the world of exciting shorts. That's just, I don't know what that'd be, trading, I guess, trading shorts.
Yeah.
It's not really what we're interested in doing. It's too challenging to short good companies.
You've been a lot more active lately, David, on LinkedIn. One of the recent posts on there, I love it because I love the band. You said the small cap market is like the song Hotel California by the Eagles. Quote, you can check out any time, but you can never leave.
Yeah.
Can you explain what all that means in the context of small caps?
Yeah, I'll give you what we use as our sort of example, and I brought up the company already, but as an example, let's take MDF Commerce, right?
Yeah.
They want to do an acquisition. They go out into the equity market. They raise $250 million. Okay, fine, and they do their acquisition. After that deal, though, they were trading $20 million in value a year. So if those investors want to exit the name, that's going to take over 10 years. So essentially, you might as well be in a private company for these bigger funds. And I think that this is a really important part, and it kind of, I guess it doesn't really matter as much in flatten up markets, right, where you invest and things are going well, good. And a lot of people, as you can appreciate, a lot of people get into small caps through deals, right? Because they're like, I can't get in this volume, it's not enough, let's do a deal. The problem is there's not the reverse really on selling and getting out. So, well, it's a big dynamic that I think, experience has been my teacher, right? And so you don't really realize how important that is until you need it, right? And so if there is some sort of correction, even the 21, 22 tech and the small cap correction, if you want to move out, if you're like, I see it coming, I it's right there in front of me. I technically I'm concerned, valuation I'm concerned. I was playing some names for a bit of mo or whatever, or I was in them for a long time. They're doing well, but I want to cut my portfolio to their exposure in half. I mean, in all reality, a lot of companies can't do that. A lot of funds can't do that. Like, we've stayed relatively nimble for that reason, because you only have to go through one cycle, maybe two, and you're like, I do not want to do that again, right? And so that's sort of an interesting nuance that I don't know where that lands with people who are sort of investing, but I think it's a big deal, and it's company specific as well, right? You might change your mind, because what you see a lot of these companies, like if they're going to be the bigger funds that will invest in a small cap, if the shit start to hit the fan, they can't do anything, and maybe the stock rolls over, gets into financial trouble, blah blah blah. They have to spend, I don't know, how long would you? I mean, your guess is probably good as mine. 3, 4 to 5 years to try to turn around, bring new management in, as opposed to just being able to sell and move on and try to find something else. But they can't, right? So I think that dynamic shouldn't be overlooked of institutional money being managed. And one of the reasons why there's not a lot of people left in the space is that is difficult to be able to sit there and say, hey, you can buy, but you can't sell, right? And I mean, just all you have to do is look at the daily volumes of these companies added up and see when they do equity deals and how easy it is to get in and out. And some of the companies get the volumes, like Kraken's done a great job of being, of moving from a small company that wasn't trading much to being able to trade, so which is awesome, and that really helps. And the liquidity is really appreciated, I think, by investors and will attract investors. But that liquidity, I mean, we take advantage of it because, we can buy these names and still, we try to have a rule that, we can get out of 80% of our portfolio within 1 to 2 months. So, depends on what numbers you're using to make that calculation. But that I think is a massive benefit in my opinion. Again, if you go into like the energy names, maybe not so bad. They're pretty liquid. But if you're in the small to mid cap tech, it's certainly something to be aware of. That's for sure.
Absolutely. 25 years in the game. When you look at the retail investor community, have you observed that perhaps if you look at Gen Z, if you look at millennials, is capital being attracted to the cryptocurrency market and perhaps being taken away from, risk on small cap stocks traditionally?
Yeah, I don't follow it that much, but I would stand to reason that it is. Yeah, I think so. Like, it's fun, it's sexy, it's on the TikTok, it's on, they got the YouTubers, the streamers talking about it. So, I mean, listen, investing is fun particularly when it's working and you're making money. So people can make it entertaining, and I guess it's had sort of its corrections, but it hasn't necessarily imploded. So people are enjoying it. So I would think so. Like, it would be hard to. I don't think we see a lot of streamers on oil and gas in Canada
No,
that are fun with their TikTok videos. To attract the youth.
Do you hold any U.S. small caps in the portfolio?
No, but I would say that there's a few names we haven't talked about it for specific reasons, but a few of the names we have, but they do have U.S. we do have a bias towards companies that have U.S. businesses right now. So obviously there's some we haven't, but like Sylogist is essentially a U.S. business. We have a few names like that, so we are biasing U.S. I mean, listen, they have whatever you think of Trump, it's pro-business. You can whatever. That's sure another podcast to get into it, but it is pro-business, and probably a second podcast would be how we're not pro-business.
No, absolutely not. This current administration.
Yeah, so that's really unfortunate. So so you just really have two different worlds right now, and so we're lucky enough to find some great businesses that are TSX listed but are in the U.S. And that is specifically by design. MDA is an exception, but I think it's such a global leader that it's willing to. We believe that it'll fight the challenge of being a Canadian company. It's unfortunate that we have to say that. Our energy names, well, we went over that, Thesis and the drillers, so I think they can again fight the fact. And unfortunately, the E&P names will just benefit by a weaker currency, which is likely coming, unfortunately, but.
Yeah, that's really unfortunate for us.
Yep.
Across the board. Yeah. Outside of the investment world, David, you're a surfer. Where do you like to catch waves?
I recently built a place in Costa Rica. So there's a town on the west coast of Costa Rica called Nasara. So I built a place there. So I'll often do.
Oh, beautiful.
Yeah. I should be there right now, but I'm not. But I just love working from there and. Essentially on the beach, so it's good enough for me. I'm a advanced beginner. It's hard to be anything beyond that from Toronto, but certainly is after the markets close, fun to jump in the ocean for sure. Good exercise.
That's awesome. What have been your favorite books on investing? Maybe books that you read very early on that inspired you to get into the world of the market.
Yeah, I think. Joel Greenblatt's one that sort of talks about spin outs and whatnot. I think it just kind of encapsulates that idea we talked about, sort of whether it's us, bank coming out of bankruptcy or coming a turnaround, or those type of ideas where, the market doesn't like it, and you have a much higher, stacking the deck in your favor, and that ability to improve. So I would say that.
Yeah, awesome. And then last question. I know you like the Eagles, obviously, from that write-up on LinkedIn. What other bands do you like to listen to? What other music?
Yeah, I'd say probably maybe my genre, but it'd be more the classic rock, so like the Rolling Stones, Tragically Hip, that type of stuff.
Zeppelin?
Yeah, Zeppelin, of
Yeah.
course. Johnny Cash, yeah, that type of
Oh,
stuff.
nice. Right on.
Yeah, old school.
Yeah. Well, it's been a lot of fun, David. Thank you very much, and
Awesome.
enjoy your next surfing trip in Costa Rica. Have a
Yeah,
good
that was a
2025.
great. Yeah, it was a pleasure. Thanks a lot, Robin. Appreciate it.
Yeah.
Cheers.
Cheers.